Hey everyone! One of the best things about commercial real estate investments is that the values tend to go up most of the time. In the last 30 years, national average values have only measurably declined 3 times. Once in the early 90s, again during the global financial crisis, and the third time, well, that would be now. Currently, there are a lot of forces in play. Recession risk, flagging consumer sentiment, and overdevelopment risks in some markets for some property types. But the big issue the industry is grappling with is the rapid surge of interest rates. Now, I did a video on how rates are affecting the commercial real estate industry a couple weeks ago, so I won't drill into the details this week, but basically the cost of debt is higher, banks are running scared and have pulled back on their lending, and many investors are seeking much higher yields today as the risk-free rate on the 6-month Treasury is in the mid 5% range. So, prices have begun to fall and yields are on the rise. It's hard to precisely measure price movement because all the hard data is backward-looking. They're based on closed deals put under contract months ago. And of course, no two buildings are exactly the same. But according to Real Capital Analytics, as of May this year, industrial prices are down 2.3% on a year-over-year basis, retail prices are down 7.4%, apartment prices are down 12.5%, suburban office is down 8.1%, and CBD office is down 6.9%. But I have to say, these numbers seem a bit overly positive to me, especially office. But whether prices are down 2% or 5% or 10% or 20%, one thing generally holds true. When prices fall, they tend to go down faster than they go up. During the financial crisis, apartments delivered the best result with a V-shaped recovery. They fell for 3 years, then they recovered in 3 years. So if you bought at the peak of the market, it took about 6 years to get back to break even. Next is retail. Retail property values fell for 3 years, but they took another 5 years to get back to the starting line. Office prices fell for 3 years, then it took 6 years to recover, and the same for industrial, down for 3, then 6 years to get back to the starting point. I'm not trying to offer a doom and gloom story. And I'm definitely not saying this cycle will be anything like the global financial crisis. But the commercial real estate market is tied pretty closely to the lending market, and the lending market is getting squeezed pretty hard right now, except for apartments. Financing for apartments is backstopped by Fannie Mae and Freddie Mac, so debt capital for apartments is holding up comparatively well. But debt availability for other property types is becoming more challenging. Given these market complexities, here are some thoughts for prospective sellers and prospective buyers. For property owners who were thinking about selling but decided to hold off until prices recover, you're basically committing to standing still for a year, or 2 years, or maybe even 3 to 6 years. We may already be at the bottom of this cycle, but maybe not. Much will depend on the Federal Reserve, and it will vary by property type and location. But the road back to break even could take a while. A lot of investors think the Fed will drop rates this year and that will fix everything. But Chairman Powell has been pretty adamant that they will not reduce rates this year, and a rate cut in 2024 is not guaranteed. So, if you plan to hold through the cycle, make sure you like your property and that you're okay holding on to the asset for a few years. That could mean you'll have a very weak return on capital. So consider whether that capital would be better deployed in other property types or locations, or maybe in other financial instruments. For buyers, make sure you have your loan dialed in, like in triplicate. Even if you have a bulletproof relationship with your bank, make sure you have a backup plan. Investors are telling me that even banks where they have significant deposits and long-term relationships, those banks are dropping out of deals. I suggest buyers consult a mortgage broker who has hundreds of lender relationships to make sure you have backup lenders in place. So, both buyers and sellers need to think outside the box right now. But some very unique investment opportunities have come to market in recent weeks. Yes, the market is choppy, but when you look at the long-term value trends, the levered yield on commercial real estate is hard to beat. To see that potential, you have to look beyond the short-term choppy waters and keep your eyes on the horizon.